EBIT, EBITDA, what does that mean? There's words that throw around when they're talking about finance. So let's try to explain them in normal English. So if anyone's taking an exam or anything, it's not so hard. So let's start out with revenue. Companies sell stuff, they make money. That's revenue. That's easy. That's just revenue, what we're bringing in. Now we subtract the COGS, cost of goods sold. That's the direct cost to make the product, materials, labor, the stuff you have to spend to actually make the sale. For example, if you run a pizza shop, COGS is the dough, the cheese, the sauce, the guy making the pies, the salaries and everything. The cost of goods you're selling. Now you're going to subtract what they call SG&A, selling, general, and administrative. That's everything else to run the business, marketing, office rent, salaries for the back office, insurance, utilities, stuff like that. In the pizza shop terms, the ads on Instagram, the manager's salary, the electric bill. Then we're going to subtract depreciation and amortization. Depreciation is like a tax write-off for stuff getting old, like your pizza oven getting old, the delivery car that you use to deliver the pizza, that's getting old. And it's worth less money, so the IRS lets you reduce your income by that, so you pay less taxes. Amortization is the same idea, but for things you can't touch, like a patent or software, you get to write off the lowering value of that. These are considered non-cash because you're not actually writing a check for those things, but they reflect the real cost because the depreciation is the cost of your building or your oven getting lower and lower or getting older is going to cost you money, but not right now. So after we get that, that's what we call EBIT, earnings before interest and taxes. This is the profit from running the business after paying for everything it takes to run it, including wear and tear, but before the bank and the government gets their cut. Now for EBITDA, we're going to add back some of those things. Add back just means you act like it didn't happen. You take the cost of the math and pretend it isn't there. So EBITDA, you add back the depreciation and amortization. Why? To make the profit look bigger and cleaner, especially if you're comparing companies. So EBITDA is EBIT, which is the lowest cost. You add back depreciation and amortization, act like you didn't get the deduction for that. So I'm going to do an example up here, but let's say you have revenue of $1,000, cost of goods sold is $600, SG&A is $100, the depreciation is $50. EBIT is $250, your real profit after everything. EBITDA is $300. You pretend the profit if nothing else wore out, and you didn't take depreciation and amortization. So remember, EBITDA is looking at your bank account before your car breaks down, before your roof leaks, before reality hits. EBIT is the truer picture of profit because it counts that wear and tear. Both are useful, just don't get fooled when the company shows you only the shiny one. So I'll say it again, the EBITDA is the earnings before income tax, depreciation, and amortization. So what they're doing is they're not taking out the depreciation and amortization to lower my income. EBIT is with that out.